How is everybody doing tonight? I hope everyone's having a great time out there. Welcome to the Strategy Room. You're in here with the banker next door, your host, Dr. Joe Berquist, on this Saturday night, May 17th, 2025. Hope everyone is having a great weekend out there so far, but I have a great show for everybody tonight. A lot of incredible things happened this week. Obviously, we kicked the week off with incredibly low inflation numbers, which was a great sign. We had the preliminary outline of a trade deal with China, which was amazing. You had President Trump signing an executive order to lower prescription drug prices, which was amazing. But then we ended the week yesterday with some crazy things that happened late in the afternoon on Friday. Obviously, the House, having problems getting their big, beautiful deal, as they call it, straightened out. We'll get into all that. But then the shocking news last night of Moody's actually downgrading the U.S. debt, which was just a huge move. Came after 5 o'clock last night. A lot of people, I probably didn't see it or weren't aware of it, but huge major news, and we're going to get into why exactly they did. I mean, the why is not a big surprise. I mean, we have been talking about it for over a year now, and that is the ballooning national debt, the amount of interest that we have to pay to cover that national debt every year. How that is just becoming such a monumental number. It's just causing us major problems. So the why there, not really that shocking, but like I said, the timing of all this was very surprising. I don't think anybody was expecting to see that last night. After 5 o'clock, stock market's closed. Everybody's, Friday night, everybody's gone home for the week, and then all of a sudden, Moody's is like, bang. We're just going to drop this right here for everybody. Okay. Well, with that being said, let's kick it off. Let's see, because I'm going to show you this week. I mean, we always kind of start the night off by looking at I guess it would help if I put this up there. Okay, so we're all, as we always kick the week off every week, looking at the national debt clock, but this is going to play into the conversation that we're just going to have here in a second on Moody's. So again, we can see here national debt still moving toward the $37 trillion. We're still sitting at a $2 trillion annual budget deficit. The Doge clock now basically says we're up to $442 billion in savings. That would be $3,940 per taxpayer, which would be great. But I want you to key in on this number right below it right here. The debt to GDP number is currently standing at 122%. That is a critical ratio there to understand, because now we're going to get into that with the Moody's news. So Moody's strips U.S. a final AAA rating over rising debt and interest costs. In its downgrade decision, Moody's cites mounting debt and criticism over deficit reduction. So Moody's Ratings has downgraded the United States long-term credit rating from AAA to AA1, stripping the nation of its last perfect rating among the three major agencies, citing sustained rising debt, ballooning interest payments, and a lack of political will to rein in chronic budget deficits. We will come back to the political will on the budget deficit. We'll come back to that in a few minutes. In its May 16th decision, Moody's pointed to a steady deterioration in fiscal fundamentals across multiple administrations, noting that it does not expect current policy proposals to produce meaningful deficit reduction in the years ahead. This one-notch downgrade on our 21-notch rating scale reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns. Moody's said, "We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration." Really? That's very interesting. Despite the downgrade, Moody's revised the U.S. credit outlook from negative to stable at the lower AA1 peg, citing continued strength in core institutions and confidence in long-term economic resilience. The U.S. retains exceptional credit strength, such as size, resilience, and dynamism of its economy and the role of the U.S. dollar as global reserve currency, Moody's said. In addition, while recent months have been characterized by a degree of policy uncertainty, we expect that the U.S. will continue its long history of very effective monetary policy led by an independent Federal Reserve. Moody's reference to Fed independence comes amid growing political pressure on the central bank. We'll get into that in a few minutes as well. President Donald Trump has stepped up public criticism of Fed Jeremy Powell, accusing him of dragging his feet on rate cuts and playing politics with monetary policy. While Trump recently said he has no plans to fire Powell, his comments have sparked concerns about political influence on central banking, a dynamic Moody's appears to be monitoring closely. And despite the signals of institutional resilience cited by Moody's in setting its outlook to stable, the numbers driving the downgrade are stark. Moody's projects the federal deficit will grow to nearly 9% of gross domestic product, GDP, by 2035, up from 6.4% in 2024, driven mainly by entitlement spending and mounting interest payments. Federal debt is expected to climb from 98% of GDP in 2024 to 134% by 2035. By then, interest payments alone could consume 30% of federal revenue, more than triple the level in 2021. And that's what we're, but I got news for him. The federal debt is expected to climb from 98% of GDP, to 100. Yeah, we're already there. We're already there. We're sitting at 122% debt to GDP right this very minute. So, yeah, we're already there. So, yeah, could it push up to 135%? Yes, it could. Now, the interest payments that they're talking about the interest that it costs us to service the national debt every year, which on right now, this 36.8 trillion right now on the national debt, it basically costs us a little over $1 trillion right now, just in interest alone. No principal paid down, $1 trillion just in interest to service that national debt. That's what we're looking at right this minute. And so they're saying that could eat up, that those interest payments alone could eat up 30%, of that money, which is just, I mean, astronomical. And the problem is that the Congress is just not doing enough at the moment to address this issue. So let's look at something else. So here was CNBC last night. So Moody's downgrades United States credit rating, citing growth in government debt. So Moody's hasn't been a holdout in keeping U.S. sovereign debt at the highest credit rating possible and brings the 116-year-old agency into line with its rivals. The decision to lower the United States credit profile would be expected at the margin to lift the yield that investors demand in order to buy U.S. Treasury debt to reflect more risk, and could dampen sentiment toward ongoing U.S. assets, including stocks. Now, what do they mean by that? They mean Treasury yields. They mean that this downgrade could cause Treasury yields to go up. That's not helping us. At the Treasury yields going up and not helping us at the moment on anything, specifically the 10-year Treasury. And let's just see here. We because some of the stuff we already hit. The yield on the benchmark 10-year Treasury note climbed 3 basis points in after-hours trading, trading at 4.48%. A proxy for longer-term debt prices fell about 1% in after-hours trading, while the S&P 500 ETF Trust that tracks the benchmark index for U.S. stocks dropped 0.4%. So, and it said that Moody's had been a holdout in keeping U.S. sovereign debt at the highest credit rating possible and brings the 116-year-old agency into line with its rivals. Standard & Poor's downgraded U.S. to AA+ from AAA in August of 2011. And Fitch Ratings also cut the U.S. rating to AA+ from AAA in August of 2023. So successive U.S. administrations and Congress have failed to agree on measures to reverse the trends of large annual fiscal deficits and growing interest costs. Moody's analysts said in a statement, "We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration." And then it goes into like massive deficit. And let me just see if there's anything there that I missed. Pretty much all the stuff that we already talked about. Less demand. Treasuries are still dealing with the fundamental factor of less foreign demand for them, and the growing size of the pile of debt that needs to be constantly refinanced is not going to change. But Moody's is symbolic in the sense that there's a major rating agency that's called out that the U.S. has strained debts and deficits. So yes, obviously it has. So okay. Now, So this was Jeremy Powell here on Thursday. Basically, Fed's Powell cautions about higher long-term rates as supply shocks provide policy changes. So Fed Chair Jeremy Powell said Thursday that longer-term interest rates are likely to be higher as the economy changes and policy is in flux. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. The supply shocks remarks are similar to those Powell has delivered over the past several weeks, cautioning the policy changes could put the Fed in a difficult balancing act. So Federal Reserve Jeremy Powell said Thursday that longer-term interest rates are likely to be higher as the economy changes and policy is in flux. In remarks that focused on the central bank's policy framework review last done in the summer of 2020, Powell noted that conditions have changed significantly over the past 5 years. During the period, the Fed witnessed a period of surging inflation, pushing it to historically aggressive interest rate hikes. Powell said that even with longer-term inflation expectations largely in line with the Fed's 2% target, the era of near zero rates is not likely to return anytime soon. So a couple big things there in that announcement. Number one, Powell said that even with longer-term inflation expectations largely in line with the Fed's 2% target. Now, Powell was not saying that 2 weeks ago, but his comments when they basically decided not to change rates were, well, inflation's still high. We need to wait for it to come down. We're still worried about it, but now all of a sudden the language has changed to, oh, well, even though inflation is in line with our 2% target. Now he's moving. That's him moving the goalpost again, moving the goalpost back. The era of near zero rates is not likely to return anytime soon. Number two, nobody is asking for us to return to zero rates or even close to 0% rates. What most people are looking for is the Fed to reduce rates by another 1%, another 100 basis points. Basically take it. So the federal funds rate right now is sitting at about basically 4.5%. They want to see that come down to 3.5%. That would bring a lot of your rates. Right now your mortgage rate's sitting at about 7%. On commercial loans sitting about 7%. That's going to bring rates, hopefully will start to bring rates back down to that 6%, sub 6 rate, hopefully bring it back into the fives. That's what we're looking for. That's what consumers are looking for. That's what banks are looking for to basically, continue to get things rolling in the economy again. But again, you see Powell basically moving the goalposts so that he could continue to, here's the key. He wants to continue to sit there and do nothing. That's what you have to take away from all this. He wants to continue the excuses, continue moving the goalpost so that he can sit there and do nothing. And I'm going to get to an article here next where of some high criticism of Mr. Powell. So higher real rates may also reflect the possibility that inflation could be more volatile going forward than in the inter-crisis period in the 2010s. Powell said in prepared remarks for the Thomas Laubach Research Conference in Washington, D.C. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. More excuses and more ifs. We may, it could, this might. If we could play, all of us could play that game all day long. The Fed held its benchmark borrowing rate near zero for 7 years. Yeah, whose fault was that? Oh, that's right. That was Janet Yellen and Jeremy Powell's fault. That's right. I forgot. And we can't forget helicopter Ben Bernanke. That was his fault too. The supply shocks remarks are similar to those Powell had delivered over the past several weeks, cautioning that policy changes could put the Fed in a difficult balancing act between supporting employment and controlling inflation. Well, if inflation's down and the labor market is, it's getting harder and harder for him to continue to get up there and basically say, it's just best for us to sit here and do nothing. Every other central bank around the world is cutting rates, but it's fine for us to sit here and continue to do nothing. All right, now I want to get to this article. So this was in zero hedge. So Schiff. So anybody who doesn't know Peter Schiff, very, very famous guy on Wall Street. Peter Schiff has been around for a long, long time. Respect Peter Schiff a lot. He says a lot of great stuff over the years. If anybody's not familiar with him, I highly suggest he's on X. He's on, he's got a blog. He's got other things that he has out there. So if anybody hasn't, ever read anything from Peter Schiff. He's also written a bunch of books. Definitely go check his stuff out. But this article basically says Schiff slams clueless Fed, said Powell is living in a kind of Baghdad Bob world. We could get, if you don't know who Baghdad Bob is, that goes back to like 1990, 1991, the first Gulf War, if you could call that a war. It lasted for like 7 days. In Wednesday's episode of the Peter Schiff Show, Peter unpacked the Federal Reserve's recent decision to hold rates steady, dissecting Jeremy Powell's latest press conference for its contradictions and disconnect from the economic realities faced by Americans. He also critiques ongoing trade policy blunders and warns that political posturing could lead the U.S. into a major economic downturn. Peter opens by reflecting on the Fed's latest move and the market's reaction, pointing out the gap between Powell's rhetoric and investors' response. Well, as expected last week, the Federal Reserve left interest rates unchanged. The Fed funds target remains between 4.25 and 4.5%. I think this was one of the most hawkish press conferences that I've seen Powell participate in. You wouldn't really know that by the reaction in the stock market. Stock market kind of, just ignored what Powell said. The bond market did get a boost, as you would expect. Noting the mismatch between the Federal Reserve statement and actual inflation data, Peter takes issue with Powell's assertion that inflation expectations remain grounded. First of all, in the prepared remarks, one of the interesting comments, or more lie than comment, is that Powell said that inflation expectations remain well anchored and the Fed's job is to make sure they stay that way. Now, I don't know what world Powell is living in, kind of like the Baghdad Bob world from the Gulf War, because inflation expectations left the 2% anchor a long time ago. I mean, hasn't Powell been paying attention to any of the Michigan numbers that have been coming out on inflation expectations that show, I think, 1-year expectations with a 6 handle and 5-year expectations have got at least a 4 handle. So you're nowhere near 2%. Peter is quick to highlight how the Fed's optimistic portrayal of the economy doesn't match the underlying risks. He questions how Powell can take the current situation, can call the current situation a great place when real economic indicators tell a different story. How is Powell describing the economy as being in a great place? How is he saying that inflation is in a great place? How is he saying that the labor market is in a great place? It doesn't sound like a great place to me. I mean, a great place would be that the odds of higher inflation are going down right now, not where the odds are going up. That would be a good place. But when you're admitting that the odds of higher inflation are going up, that's pretty far from a great place. Turning the monetary policy to international trade, Peter addresses the persistent uncertainty around trade negotiations with China. He suggests that China would be wise to reduce its reliance on American consumers who are increasingly unable to afford goods they import. But I don't have a lot of optimism for these Chinese trade talks. In fact, I think the Chinese may finally be doing is the right thing. They've been resisting doing the right thing for a long time because there's always some short-term pain. Because the biggest mistake that China made, and I've been talking about this for decades now, was hitching its cart to our wagon. They tried to service the U.S. consumer, supply the U.S. consumer with goods without recognizing that the U.S. consumer was broke and really couldn't afford to pay for the goods. Peter concludes with a critique of protectionist policy, using a recent proposal by Donald Trump as a case study in economic misunderstanding. He points out that the self-defeating nature of a proposed 100% tariff on foreign-made films, a move that threatens an industry where the U.S. actually excels internationally. Probably the most ridiculous thing that the president said this week wasn't even during that interview. It was on a post on Truth Social out of the blue. Trump posts, "I'm going to impose a 100% tariff on movies filmed outside the United States." 100% tariff, right? First of all, the movie industry, Hollywood motion pictures, that's one of our industries that we have a trade surplus. We export a lot more movies than we import. So movies, the motion picture industry, Hollywood entertainment, that is not a problem that Donald Trump needs to fix. So again, I would disagree with Peter, and I think one of the articles here I'm going to show in a second, obviously, And this may have taken place before all the China news came out on Monday with the trade talks. So again, a lot of people had a lot of, again, he says he didn't have a lot of optimism for the Chinese trade talks. I didn't think things would happen as quickly as they have. As for sure, I thought that this was going to take 6 months, 8 months before China would finally come to the table. Now, again, his kind of comments, I don't fully agree with some of these comments of, oh, well, China was finally doing the right thing. The United States, should have finally done the right thing by disconnecting from China. So both sides could make that argument here of maybe we shouldn't be depending quite so much on the other. And again, the Hollywood tariff stuff, I'm not even going to go there with that. Whatever. I mean, that's kind of beyond the pale, if you will. I'll skip through that one. But let's keep going here, because I want to show you guys a few more things before we get to the trade stuff here. So Jamie Dimon on Thursday, he came out and basically says that, hey, look, he still thinks that recession is on the table for the U.S. So JP Morgan CEO Jamie Dimon said there is still uncertainty on the tariff front, but the pauses are a positive for the economy and the market. Michael Ferroli, the firm's chief U.S. economist, said in a note to clients on Tuesday that the recession outlook is still elevated, but now below 50%. Even at this level, you see people holding back on investment and thinking through what they want to do, Dimon told Bloomberg Television. So Wall Street Journal titan Jamie Dimon said Thursday that a recession is still a serious possibility for the United States, even after the recent rollback on tariffs on China. If there's a recession, I don't know how big it will be or how long it will last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point. Specifically, Dimon said he would defer to his bank's economists, who put recession odds at close to a toss-up. Again, and we said, Michael Ferroli said there was about a little bit below a 50% chance. Dimon's comments come less than a week after the U.S. and China announced that they were sharply reducing tariffs on one another for 90 days. And now we're going to get into that. So the important thing I wanted to point out here is that basically the economists at JP Morgan Chase, they basically now rate the possibility of a recession just below 50%. So basically they still think it's on the table, but the possibilities are now starting to come down a little bit, which is obviously a good thing. So now let's get into the trade conversation for a little bit. And so big, huge announcement on Monday, basically, and what we see here in this article is the 90-day trade deal between the U.S. and China, what has been agreed to so far. So Washington and Beijing reached a temporary deal that rolled back many of the moves the countries have made against each other since April 2nd. So officials from the United States and China announced on May 12th that they reached a 90-day agreement aimed at relieving trade tensions between the two countries after meeting in Geneva over the weekend. Washington and Beijing have agreed to significantly reduce the tariffs imposed on imports from each country. The deal only affects measures taken by the United States and China since April 2nd. So starting on May 14th, both countries will significantly reduce certain components of their tariffs against one another, according to a joint statement attributed to both the United States and the Chinese Communist regime, published by the White House. The two countries pledged that they would establish a mechanism to continue discussions around economic and trade relations. So the move will reduce U.S. duties on Chinese goods to 30% from 145%. China, for its part, will drop its counter tariff to 10% from 125%. The U.S. duty of 30% is based on a combination of a 20% tariff imposed on China earlier in the year and a 10% tariff that is generally being placed on all U.S. trade partners. The 20% tariff was assessed as a penalty for China's role in the international trafficking of fentanyl, according to the United States. The 10% tariff is on par with the United States global baseline tariff on imports that remains in place as President Donald Trump and his cabinet work to renegotiate trade agreements worldwide. China is matching the global baseline tariff rate with its own 10% duty on U.S. imports. Separate U.S. tariffs on Chinese electrical vehicles, steel, and aluminum remain in place. And then it goes on to say that many old trade barriers remain. The deal was focused on actions taken in the past 5 weeks, but did potentially include some concessions on non-tariff trade barriers. On the U.S. side, additional tariffs and barriers on Chinese imports that were assessed before April will remain in place. These include sector-specific duties on electric vehicles, steel, and aluminum, aluminum. No changes to the Trump administration's move to end the de minimis exemption on goods imported from China and Hong Kong to the United States were mentioned. The May 2nd move ended a policy that allowed duty-free imports of packages worth less than $800. That measure is seen as a blow against exporters of low-value goods, particularly retailers that ship directly from manufacturers in China to customers in the United States. On the Chinese side, it was unclear what actions would be taken to halt countermeasures assessed against the United States since April 2nd. In April, China imposed additional export controls on critical rare earths elements, opened an anti-dumping investigation into the chemical company DuPont, and penalized a number of U.S. technology and defense firms. So, we'll see how this ultimately pans out. I mean, this is kind of like a 90-day reprieve, if you will. So this isn't a full trade deal, but it is certainly, I don't think anybody was expecting this. I mean, Scott Bessent and his team went over to Geneva last week. They had a 10-hour meeting with the Chinese delegation, Chinese representatives. And, I think that appeared to just be an opening conversation. I don't think anybody thought that on Monday that they were going to come out and basically say, hey, we're doing a kind of a 90-day pause. We're both ratcheting back. We're going to continue the conversation, continue going forward. I mean, it was just an enormous announcement here and a great step in a good direction. So, and then here from CNBC, it basically just says, U.S. and China agree to slash tariffs for 90 days and major trade breakthrough. We had very productive talks, and I believe that the venue here in Lake Geneva added great equanimity to what was a very positive process, U.S. Secretary Scott Bessent said in a news conference. And then we'll continue to go on. Now, here's interesting. So Treasury Secretary Bessent says he's likely to meet with China again in the next few weeks to work on a bigger agreement. So the exact details of the meeting, such as location, have not been set yet, but there is now a mechanism for further talks, Bessent said. The 20% fentanyl-related tariff from the U.S. remains in place, so most Chinese goods face a 30% rate in total, but it's down from 145% previous. Global stock markets rallied sharply on Monday after the tariff pause was announced. So Treasury Secretary Scott Bessent said Monday that he expects to meet with Chinese officials again in the coming weeks to continue trade negotiations. I would imagine in the next few weeks we will be meeting again to get rolling on more fulsome agreement. Bessent said on CNBC's Squawk Box, the exact details of the meeting have not yet been flushed out, but the comments come after the U.S. and China announced a 90-day pause. What we have with the Chinese is a mechanism to avoid upward tariff pressure, Bessent said on Monday. Bessent said there was a very long and in-depth sidebar regarding fentanyl between two officials at the meeting. I think what we saw here in Geneva was the Chinese are now serious about assisting the U.S. in stopping the flow of precursor drugs, Bessent said. Global stock markets rallied, yada. Okay, it was good news, but again, very positive that we are now going to see them get back together again here in just a couple of weeks. So this at least is setting the stage that we may have a very positive outcome here in a much shorter period of time than I think myself and many other people were expecting. Like I said, I have been saying for the last few weeks, I thought this would take a lot longer to play out. I thought this would take 6 months, 8 months, 9 months. Nowhere did I expect that this was all gonna come together, within a month time period. I mean, that's just pretty amazing. And again, you got to pump the brakes a little bit. We still have a very long way to go, but this is obviously major progress in that direction. Again, some additional comments from Bessent. So Bessent sees tariff agreement as progress in what he called a strategic decoupling with China. Like I said, like on the Peter Schiff article that we were just looking at, Peter Schiff was saying, well, hey, China should have done the right thing according to him in pulling away from the U.S. Well, like I said, you could say the exact same thing. I would say the exact same thing in reverse. I would say that the U.S. should have decoupled from China, and we should have done that started to do that many years ago. Treasury Secretary Scott Bessent said Monday that the trade agreement reached over the weekend represented progress in strategic decoupling from China. And again, gets into details of the China trade pact. Treasury Secretary Scott Bessent said Monday that the trade agreement reached over the weekend represents another stage in the U.S. shaking its reliance on Chinese products. Though the U.S. decoupling itself from its need for cheap imports from China has been discussed for years, the process has been a slow one and unlikely to ever mean a complete break. However, Bessent said there are now specific elements of decoupling in place that are vital to U.S. interests. The U.S. imports nearly $440 billion in goods from China in 2024, running a $295 billion trade deficit. We do not want a generalized decoupling from China, he said during an interview on CNBC Squawk Box. But what we do want is a decoupling for strategic necessities, which we were unable to obtain during COVID. And we realized that efficient supply chains were not resilient supply chains. Yes, absolutely. And then it goes into the pandemic, details of the Chinese pact, which we've already covered. So we're not going to go back over that stuff. So then President Trump chimed in, and basically Trump says China will open up to U.S. businesses and suspend trade barriers. So President Donald Trump said China agreed to open after the two countries agreed to temporarily slash most of the tariffs on each other's goods. Trump said that was maybe the most important thing to come out of the trade talks with Treasury Secretary Scott Bessent, U.S. Trade Representative Jamie Greer, and their Chinese counterparts. The U.S. and Chinese officials said they struck an agreement to pause tariffs. Obviously, we talked about that. But President Donald Trump said Monday that China agreed to open up after the two countries announced they would temporarily slash most of the tariffs on each other's goods. Trump offered few details about that development, but said it was maybe the most important thing to come out of the high-level trade talks. Trump indicated that those purported commitments have not been cemented yet. We have to get it papered, he said at the White House before signing an executive order on U.S. drug prices, but they've agreed to open up China. Trump's remarks came hours, obviously, after the trade agreement was announced, or the trade pause, rather, whichever you prefer. But again, interesting developments, as you say. And then obviously we got this article next, recession fears fade after tariff agreement with Trump. So Monday's surprise trade deal between the U.S. and China lowered the chances of a recession. Forecasters said the trade deal the trade deal meant higher growth and lower inflation. Despite the improved outlook, the remaining tariffs are still a drag on the economy. Again, I question this whole thing, this whole negative, negative outlook around the tariffs. Oh, the tariffs are going to cause massive inflation. Oh, the tariffs are a drag on the economy. Oh, the tariffs are going to wreck the economy. This and that. Where have we seen that yet? Where have we seen that? We just got a major trade agreement with the UK last week that was a huge win for us. We've got 100 other countries right behind that coming to the table. China came to the table because basically we were about to wreck their economy. So they came back to the table, but hang on a second. And we got this. Tariff receipts topped and I talked about this last week. Tariff receipts topped $16 billion in April, a record that helped cut the budget deficit. Custom duties totaled $16.3 billion for the month, some 86% above the $8.76 billion collected during March, and more than double the $7.1 billion a year ago. The fiscal year-to-date deficit fell to $1.05 trillion, which is still 13% higher than a year ago, but for the first time in quite a while, it's moving in the right direction. So again, where is the, we've got that. So we got record tariff revenue coming in. We have inflation going down. We have all these countries coming to the door to cut trade deals, but yet somehow again, we got this notion out there that the trade deals are going to wreck the economy. What am I missing here? What am I missing here? All right, let's see here. Okay, but now obviously recession fears fade. We also had, like I said, the comments from Jamie Dimon and his economists over there at JP Morgan Chase basically say that, okay, recession may still be on the table, but it's falling. The odds are falling, and we see that here again, which again is a great thing. So here is another question. So does the trade truce between the U.S. and China change the Fed's strategy? So The U.S. trade deal with China has eased the fears of a recession, but remaining tariffs could still threaten the Federal Reserve's dual mandate of keeping inflation low and employment high. That has caused traders and forecasters to split on how the Fed will change its strategy in the months ahead. Some say the lower tariff levels will have less of an impact on the job market, but will push up inflation, requiring the Fed to hold rates higher for longer, while others say the uncertainty around tariff policy will stop businesses from hiring, requiring the Fed to step in with a rate cut sooner rather than later. So again, now, you're starting to see the questions now. So obviously Peter Schiff, critical of what Jeremy Powell was doing there, basically saying, hey, things are not all right. How can you just hold interest rates steady? Now you're starting to get some of these other things are creeping in. So basically what this is saying in so many words is, how long can Jeremy Powell continue to sit there and do nothing? Like this is not going to be a winning strategy. Now here's another side of it too. So U.S.-China trade war pushed global supply chain near breaking point, new data shows. So the U.S.-China trade war de-escalation and tariff pause came with global supply chain stress near a tipping point, according to new data. GEP's Global Supply Chain Volatility Index shows a steep retreat in manufacturing orders after a massive stockpile. Even with trade deal progress, the rapidly changing landscape is clouding manufacturers' outlook and dampening investment, according to the data. So the trade deal truce between the U.S. and China arrived just as President Trump's tariffs took a big bite out of North American and Asian manufacturing, with a steep retreat in April purchasing activity after the rush to hoard supply, according to the GEP Global Supply Chain Volatility Index. The pause on tariffs is a major relief for manufacturers in both the U.S. and China. Our supply chain volatility index shows manufacturing demand in China is dropping steeply, and U.S. manufacturers are aggressively stockpiling key inputs to buffer against tariffs. But according to PyTech, the trade deal won't quickly quiet U.S. manufacturers' anxiety about how to reduce risks related to China for the long term. As they maneuver to de-risk and limit exposure to China, the rapidly changing landscape and uncertainty is clouding manufacturers' outlook and dampening their capital investment and supply chain. Well, I think that all depends on how quickly a deal gets done. Right now, as of yet, we haven't, hasn't been any major impact. If this continues to drag on for another 6 months, 9 months, obviously then you will begin to see a bigger impact. But if a deal can be worked out, I would say in just the next couple of months, it's going to be fine. It's going to be a-okay. There's not going to be any big deal. But the issues on China, as I showed last week when I went through the whole, we did it last week. If anybody missed last week's episode, go back and take a look at it. Maybe just look. I did about a 20-minute piece on China. I ran through about 6 or 7 articles on China, what was happening with China's economy, how China's economy was basically being crippled by these tariffs, and things are going south there very quickly. I mean, the job losses are up 3-4 million. It's gotten so bad that China has basically just stopped reporting data altogether. So, was it any wonder that China ran back to the trade table as quickly as they did? So, but I wanted to point this out. We talked about the trade tariff receipts. Now this is interesting. I want to show you guys this for a second. If all these stupid ads would stop popping up here. So this article is basically Trump's extraordinary tariff campaign in 2 charts. So 2 charts illustrate President Donald Trump's historic tariff campaign, which has raised import taxes to their highest level since the 1930s in just a few months. The tariffs have reversed longstanding U.S. economic policy, which has favored low tariffs and free trade. Again, I hate the term free trade. Free trade is a fallacy. It is a joke. It's a ridiculous term. Okay. There is no such thing as free trade. The free trade is the U.S. charges everybody around the world nothing, and they all tariff us to oblivion. Okay. That's free trade. That to me is not free trade. Free trade to me would be either no tariffs on either side or equal tariffs on both sides. Okay, they charge us 10%, we charge them 10%. Okay, there you go. That would be, in my mind, an equal distribution, if you will, and that would be free trade. What we have right now is not free trade. Trump's rapid fire trade policy changes have set the effective tariff rate up and down rapidly, with more announcements expected in the days ahead. So now I just want to show you guys this because these are some really interesting charts because there are a lot of historical things to look at here as well. So this first chart here basically says effective tariff rate surge underscored shift in trade policy. So the average tax levied on U.S. imports currently sits at its highest since 1934, according to the Yale Budget Lab. So you could see here going all the way back to 1933, the effective tariff rate was 19.8%. That began to come way down through the Great Depression, even through World War II. And we probably came down to, in 1954, after World War II, we came down to a low of about 5.17%. Then that headed back up about 10 years later, that headed back up to 7.72%, but then has basically dropped ever since 1965. So for over 50 years, we've continued to see a drop in this. Now, here is what I find interesting. So if you go into this time frame around 72, 73, we were at about 5.2%. What happened in this time frame? Does anybody remember? Nixon went to China and opened up China to the U.S. This was the very beginning of our new relationship with China. He went over, visited with Mao, who was a psychopath that killed hundreds of millions of people, but that's okay. We're not going to go there. And he basically opened up, the trade relations between the two countries and kind of got the ball rolling. And you see, ever since then, it has come way, way down. And then we get to 1994. Now, what happened again in the 90s? Who was in there? George Bush, the first Bush, was president. And George Bush, again, after Tiananmen Square in 1989, Chinese, communist regime, not having a good time. He went over there and basically said, hey, look, work with us. We want you to make more of our goods. He basically, the next step in that trade evolution took place there. And again, you see it start to decline again, going from about 3.2%, creeping all the way down here to 135, 135, 135. Now and this is where we're hovering in here, 1.49. 2017. So Trump gets into office. What happened? 2017. We go up to just a little bit to 2.94. We come over here. Now we're at 3.01. But then, Biden brings it back down to about 2.42. But now we are back up to 17.83%. Now, again, I think what everyone has to keep in mind, will this ultimately stay at 17.83%? No. I seriously doubt it. There are going to be a lot of trade deals made and negotiated over the next 6 months. And those trade deals, I would say that this, Trump has said that he's setting his minimum at 10%. That's where he wants to be. So my guess is that this will eventually ratchet itself back down. As more and more trade deals are cut, this will eventually come back down, and I think it will settle in somewhere around 10%, probably maybe a little higher, maybe 11% or 11.5%, something like that. But I think that's ultimately where this thing will end up, but still much higher. So we will see a lot more trade revenue coming in our doors at the end of the day. So, and again, let's consider the UK trade deal that we just saw last week. Let's consider that let's use that as a template for the moment. Okay, what happened in that trade deal? Well, our tariffs went from 0 to 10%, and the UK lowered their tariff from 5% down to 1.8%. So, basically a net effect of we're ahead by about 8%. So that's fantastic. That's a better trade deal that we've had with the UK in a very long time. Now, some people would say, okay, yeah, but we have a positive surplus with the UK. Okay, that's fine. That's great. But it's still a better deal at the end of the day. Still a better deal. And again, I think the tariffs at the end of the day are going to be extremely effective. I think they're going to be extremely effective. But then here's another interesting chart. So changing policy causes swings in the effective tariff rate. So the effective tariff rate, the average tax on all U.S. imports, has jumped up and down as President Donald Trump has changed his trade policy this year. To see a specific data point, tap on the thing. So let's see. So we start in January here. We're at 2.42%. And then we get to March 3rd, tariffs kick in on Canada, Mexico, and China imposed. Basically, so they shoot up to 9.52%. And then we have the next leg up, which was Liberation Day. Tariffs imposed, auto tariff goes into effect, and now we jump up to 22.44%. And then we have April 15th, we jump up to 27.99%, which was the reciprocal tariffs paused, and then China tariff increases to 145%, and then we get the China tariff temporarily reduced to 30% on May 12th. So now we're back to 17.83. So you can see this jumping around, and I would say that that's fine. I would say that there's nothing wrong with that. That is trade negotiations. I think that with the author of this article, I think they try to put this chart out there like, oh, look at how crazy this is. It's just jumping all over the place. To me, it doesn't, that, roller coaster, if you will, doesn't really matter. That just to me is that's just trade negotiation. And I think this thing will bounce around a little bit more. Give it another, like I say, give it another 6 months. I think it'll continue to bounce around again. But at the end, I thought they were good charts. I thought they were interesting charts. I thought people would find them interesting, give it a little bit of insight there on some of the stuff that was going on. So again, we have this. I just want to go back to this thing at the beginning here for a second. So, we have, this Moody's stripping the U.S. of the final AAA rating over rising debt and interest costs. And basically part of their rationale was that, Jeremy Powell is not bringing interest rates down. He's not helping the situation. So we just went through this whole course for about the last 45 minutes, this whole conversation on, Moody's taking the debt rating down. The debt is still up. We went through, we hit on basically Jeremy Powell. Now, basically he's coming out last week, like I said, moving the goalpost again, making excuses for why he doesn't want to do anything. But the criticism is now starting to come. The criticism is now starting to come out. And basically people are saying, hey, look, Powell is not going to be able to sit here forever. He's not going to be able to sit here and basically say, oh, can't do anything. Sorry, sorry, you're out of luck, whatever. That is just not going to fly for a whole lot longer. And it will be, I think if I were to make a prediction now, I would say that Powell has to do something here in the next couple of months. He's not going to be able to sit here he's not going to be able to sit here for basically another year and just not do anything. That's not going to fly. He eventually is going, the market is eventually going to put so much pressure on him that he's going to have to do something. It's not going to be about him, not wanting to help Trump. It's going to be, he's going to get so much pressure on him that he'll have to act. So that is my guess. So now let's go to the other part of this conversation. So what the other part of why Moody's downgraded, and that is what is going on here with this giant, the big, beautiful bill in Congress, which basically the other big news that we got yesterday was that this bill stalled. Why the one big, beautiful bill stalled and what's next. So the reconciliation budget has hit a rough patch in the House as moderate and conservative Republicans fight for differing priorities. So Republicans were dealt a major blow on May 16th when the House Budget Committee failed to advance a multi-trillion-dollar budget package created through a process that does not require support from Democrats. The package would fund President Donald Trump's agenda items on the border, energy, and more, while making permanent the tax cuts passed during his first presidency. It would also raise the debt ceiling to $4 trillion. So there you go. We're raising the debt ceiling. This is part of why Moody's basically said that there was not enough being done in this legislation to address the debt. There was not enough budget cuts. There were, again, to go back to our debt clock for just a second, we're approaching 37 trillion in national debt. We're still running a $2 trillion annual federal deficit, which is probably going to settle in more at around, I would say, probably 2.3, 2.4 trillion by the time we get to the fiscal year end at September 30th. So, and that's the big gripe, that's the argument that Moody's is making, is that, hey, you guys in Congress are working on this big bill, but you're not doing anywhere near enough to do something about this. And this is what I've been griping about for months now on the live stream, is that Congress, and not it's not one side of the aisle or the other, it's both sides. They're not serious about cutting spending on either side. They're not serious about cutting spending, and this is the problem. And this problem is going to continue to balloon until they finally get in there and do their job and get serious about reducing this spending. So and again, it just talks about like the bill not going through here. So what were some of the big issues? So here are 4 big reasons why the reconciliation bill has stalled. Obviously, the SALT property taxes. This is a big issue in like New York, California, New Jersey. So SALT is a big issue there. Medicaid, disagreements about Medicaid, a federally funded and state administered health insurance program for low-income Americans, have caused friction too. IRA tax credits. Republicans have also differed over the timeline for eliminating energy-related subsidies from the Biden-era Inflation Reduction Act. And then finally, the cost. Some Republicans take issue with the cost of the bill and its effects on the deficit. The exact estimate of the bill's deficit effects vary. The CBO estimates that it would add $5.15 trillion to the deficit between 2020 and 2034. Other sources have generated higher estimates. So wait a minute. So now you're not talking about not only not cutting, but you're going to add to the deficit over the next 10 years. What am I missing here? The Committee for a Responsible Federal Budget, a bipartisan group led by former public officials, estimates that reconciliation, including the Senate's spending thresholds and the interest on debt required for such spending, will cost up to $6.9 trillion. The GOP budget extends the 5-year tax holiday we've been enjoying, but because it doesn't cut spending much, it increases the deficit by over $300 billion a year, wrote Rep. Thomas Massey, a fiscal conservative, on X in February. Some Republicans have raised concerns about the timing of projected costs and savings. After meeting with Scalise and Johnson on May 15th, Roy told reporters that the bill had too much backload in the savings and too much front load in the tax policy. Some are concerned about the bill's length. Presently, it's 1,100 pages. Well, you really didn't think that they weren't going to jam all their pork in there, did you? I mean, come on, seriously. Why do you think they wanted to do one? Why do you think they want to do one giant bill? Why do you think Congress, both sides of the aisle, why do you think they love doing these big bills? Because they want to be able to jam all their crap in there. That's the secret sauce. They want to jam all their crap in there, and they want to pass it in the middle of the night and then run away the next day so they don't have to answer any questions about it. And then over the course of the next couple weeks afterwards, as people review these big giant bills, then you find out all the crap that got loaded in, and then they have the same arguments. How could we vote for that? Oh, we didn't know what was in it. Oh, blah blah blah. Like it's you see it doesn't take a genius to figure out how this game is played here. And they don't want single bills. They don't want to say, oh, well, let's vote on this bill and then let's vote on that one. And they don't want to break this down into 20 or 30 smaller bills, because my gosh, then they wouldn't be able to get their crap in there. So that's how it is. But so again, this is what the fighting is going on now. But the bigger thing I wanted to focus on was why Moody's downgraded yesterday. And it's because this bill is not doing anywhere near what it should be in terms of cutting. And remember what I said last week. The Republicans came out and basically said, they put this big flashy headline out there where they said, oh, guys, hey, this is great. We cut $1.5 trillion from the deficit. No, they didn't. They're saying $1.5 trillion over 10 years. So that's basically less than $300 billion a year, which is, when you're running a $2 trillion deficit, is, wait for it, that's nothing. That's absolutely nothing. If they want to say that they're going to cut $1.5 trillion next year, and they're going to reduce that deficit down to maybe like 500 million. Okay, now we're talking. Now you're making some headway here, but no, that's not what was happening. And this is exactly why Moody's downgraded, because of what's going on here. And then this is CNBC. House Budget Committee rejects Trump's agenda bill in major setback for GOP leaders. The GOP-led House Budget Committee voted to reject a sweeping package for President Donald Trump's agenda on Friday, dealing an embarrassing setback for Republican leaders. The vote in the Budget Committee was 16-21, with 5 conservative hardliners joining all Democrats in voting against the multi-trillion-dollar legislation. After the vote tally was read, Rep. Jody Arrington, Republican from Texas, the committee chair, adjourned the hearing and told members they would not be meeting again this weekend. Negotiations with the GOP holdouts will continue in the coming days, and Republicans on the panel will try to regroup as soon as Monday. Republican leaders concede the massive bill isn't ready for prime time, and that critical changes will need to be made in the coming days to tax and Medicaid provisions to win over recalcitrant members. Yes, absolutely. So we'll see what happened there. Now, let's take a look at some other things here. So just a couple of things of what maybe are some of the positive things that are in this bill. So Republican tax plan includes sweeping changes for small businesses. So Republicans released a $4.9 trillion tax plan with a long list of business tax credits. Proposed revamped Opportunity Zone program would expand it into rural areas. Legislation would cut clean energy tax credits, and critics say may reduce health care access. So the much-awaited Republican tax plan was released in the U.S. House of Representatives on Monday, but the legislation, which some estimates say will cost around $4.9 trillion over the next 10 years, is only the opening gambit. While specific policy points are likely to change, the credits and cuts included in the tax plan will set the debate in the coming weeks. Many of the tax credits being debated have already begun to expire or will expire in the coming years. But let's see here. Here's a list of nearly every tax credit and deduction that could afford small businesses included in the legislation. So a new Opportunity Zone round. The bill would make tweaks and changes to the existing Opportunity Zone program created under Trump's 2017 tax plan, which gave certain tax benefits to new real estate developments and investments in certain low-income census tracts. The bill's proposed changes include more reporting, an effort to prioritize more rural areas as opportunity zones, and an extension of the program's timeline to the end of 2033. An expanded business interest deduction. So currently, businesses can expense interest for the taxpayer year limited to 30% of adjusted taxable income, among other factors. The bill would increase the cap on the deductibility of business interest expense in 2025 and beyond by allowing it to be calculated without taking into account deductions for depreciation, amortization, or depletion. Repealing the third-party transaction rule. Under current law, third-party organizations have to report any de minimis payments exceeding $600 for goods and services, something critics say is an overly burdensome regulation. Yes, the bill would modify that requirement to include only people who earn more than $20,000 or had more than 200 separate transactions during the tax year. A separate requirement that businesses report any payments to a contractor of $600 or more would be raised to $2,000 and indexed to inflation for each year thereafter. Expanded qualified business income deductions. Right now, a person may deduct 20% of qualified business income from a partnership, S corporation, or sole proprietorship, but that is set to expire at the end of this year. The legislation would make this deduction permanent and would also raise the deduction to 23%, as well as tweak the phase-in for income. And what are some of the other things here? So, and I can't read through every single one of these, but allow for immediate expensing of properties. That's a great one. Changes to research and development deductions, new special allowances for certain properties, changes to foreign income deductions, removal of tax on tips. Yes, absolutely extended one. That's a great one. Removal of taxes on overtime pay. That's another winner. Expansion of employer child care credit. Yes, another winner. That's a great one. Extension of Paid Family and Medical Leave Act. Yes, another great one. Extension of employer student loan assistance, another good one. Changes to employer health reimbursement arrangement plans. Expansion of health savings accounts. Reprieve on indoor tanning services. Not sure what that one's about. New lender breaks for rural real estate loans. Lenders would be allowed to exclude 25% of the interest they received on loans secured by rural or agricultural real estate. That could be interesting. And then finally, breaks for manufacturing businesses. So under the current law, businesses with average annual gross receipts below $25 million over the prior 3 taxable years are permitted to use the cash method of accounting, are exempt from the cap on business interest deductibility, are exempt from the requirement to account for inventories, and are exempt from certain capitalization rules. The 25 million threshold is indexed for inflation, and in 2025 is at 31 million. The legislation increases the gross receipts threshold for manufacturers from 25 million to 80 million and would be indexed to inflation, bringing the amount to 100 million in 2026. So again, that's a lot of great stuff potentially in this bill for, either small businesses or investors. So that is great stuff in there. Okay. Here was another interesting thing that I saw in the tax bill. So no tax on Social Security benefits or a $4,000 senior bonus, how they compare. So House Republicans, one big beautiful tax bill includes a new perk for older adults, a $4,000 deduction framed as a bonus. The deduction would be available to individuals ages 65 and over who meet certain income and other requirements. The proposal provides some financial relief for seniors that was promised on the presidential campaign trail without the high cost of eliminating taxes on Social Security benefits, experts say. So House Republicans in the tax bill include a new temporary $4,000 deduction for older adults. The change, called a bonus in the legislation, is aimed at helping retirees keep more money in their pockets and provides an alternative to the idea of eliminating taxes on Social Security benefits, which President Donald Trump and some lawmakers have touted. The bill provides a historic tax break to seniors receiving Social Security, fulfilling President Trump's campaign promise to deliver much-needed tax relief to our seniors. The proposal calls for an additional $4,000 deduction to be available to adults ages 65 and over, whether they take the standard deduction or itemize their returns. The temporary provision would apply to tax years 2025 through 2028. The deduction would start to phase out for single filers with more than $75,000 in modified adjusted gross income, and for married couples who file jointly with more than $150,000. As a tax deduction, it would reduce the amount of seniors' income that is subject to levies and therefore reduce the taxes they may owe. Notably, it is not as generous as a tax credit, which reduces income tax liability dollar for dollar. A medium income retiree who brings in up to about $50,000 annual may see their taxes cut by a little less than $500 per year with this change. It's not nothing, but it's also not life-changing. Yes, I would describe it as that. Yes, I would agree with that. And then it goes in and, new deduction versus eliminating taxes on benefits. So, I would say that, this is it's very interesting, but I would describe this as being very gimmicky. It's very gimmicky. It's not, what I would say is this is not what we want. And this is not what was campaigned on. I think we want no tax on Social Security, period. End of story. You already paid taxes on it for some people 40 years, 45 years, maybe 50 years. You paid your taxes. Okay. No tax on Social Security. And just so everybody understands, when Social Security was first enacted and first rolled out in the 1930s as part of the Great New Deal, under Roosevelt, it originally was not taxed. Social Security did not start being taxed until they made a change to the Social Security Act in 1983. So it's only been, just a hair over the last 40 years that Social Security benefits have been taxed. For the first, about 45, 50 years of that program, there were no taxes on Social Security. So I want to just go back to what was originally intended, the way it was originally designed and originally carried out, which was no tax on Social Security because you already paid your taxes up front. So, so again, I mean, this is nice. A 4,000, this $4,000 kind of, it's not, like I said, what do they call it, as a bonus, but this only lasts for a couple of years and then it's gone. So no, I don't want that. I want you to stop taxing Social Security. Now, obviously, I'm not a senior. I'm not earning Social Security yet. I'm not going to be earning Social Security for a long, long time. But hopefully, God willing, I will get there one day. And when I get there, I don't want to pay. I don't want to pay any tax on it because I've already paid my taxes. So, so that's just my 2 cents. If anybody wants to chime in on that one, please feel free to do so. Like, what do you think? Would you rather have this $4,000 bonus for the next 4 years, or would you rather, they just stop taxing Social Security? So, there's a question for you. All right, let's see here. Federal Reserve will reduce staff by 10% in coming years, Powell memo says. I wonder why that is. Could that be because they're spending $2.5 billion on a new headquarters? If anybody watched last week, I reported on the fact that the Fed is spending $2.5 billion on their new headquarters building, which is insane. It's insane. Even the FBI wanted a new headquarters, and they only asked for $300 million. And these guys, what are you putting in there? $2.5 billion. What are you putting? Are you coating the building in gold? Like, what? I don't understand. Maybe it's going to be a new Fort Knox. Maybe that's what. Maybe they are. Maybe they're going to buy a whole bunch of more gold and they're going to put it in there. And since we still don't know if there's any gold actually at Fort Knox. But I don't know. But anyway, okay. So this article. So the Federal Reserve will look to reduce its headcount by 10% over the next couple of years, including offering deferred resignation to some older employees. Central Bank Jeremy Powell said in a memo, experience here and elsewhere shows that it is healthy for any organization to periodically take a fresh look at its staffing and resources. The Fed has done that from time to time as our work priorities or external environment have changed. Powell said in a memo obtained by CNBC. The central bank chief added that he has instructed leaders throughout the Fed to find incremental ways to consolidate functions where appropriate, modernize some business practices, and ensure that we are right-sized and able to meet our statutory mission. One method for shrinking the Fed staff will be to offer a voluntary deferred resignation program to employees of the Federal Reserve Board who would be fully eligible to retire at the end of 2027. The central bank said in its 2023 annual report that it had just under 24,000 employees. A 10% reduction would bring that number below 22,000. The memo comes as the Trump administration has pushed for cost cuts across civil service agencies, spearheaded by Elon Musk and Doge. Musk has previously called the Fed absurdly overstaffed. Powell's memo did not mention Musk or Doge as a factor in the decision to shrink headcount. I would agree with Elon Musk's assessment there. 24,000 employees. Why does the Fed need 20? Are there 24,000 PhDs over there that I don't know about? Like I think I missed out on that one. Yeah, that's kind of crazy. That is kind of crazy. 24,000 employees at the Fed. Like, why? Now, I'm sure that is, the Fed's got a number of banks across the country. Was it 9 or 11? I forget off the top of my head the number of Federal Reserve branches out there. But yeah, I mean, 24,000 employees, that seems like way, way high. That seems like you could cut that number in half. Like literally you could cut to 12,000 employees and they probably wouldn't miss a beat. That's just kind of my guess there. So, okay. Now, before we go to this, we're at that time in the program. So I want to take a break here for just a second, because at this point I do like to talk about I like to do a couple things. I like to talk about what are the economic indicators we have coming out for next week. I like to talk about the episodes that I put out in this past week. And then I also like to give you guys some banking news, banking information that came out this week. So let's kick it off with the episodes that came out this week. So on Monday, I had episode 382 came out, and it was I thought, interesting, internal versus external hiring. So this episode examined an article from Bank Director that was titled "The Tough Choice Between Internal Promotions or External Hiring." So the best thing a company can do is strike a balance between internal talent development and bringing in external talent. This will allow a bank to build a strong, adaptable leadership team, but beware. There are pros and cons to both strategies and pitfalls all around. So, and I think I got into some pretty interesting thing. I find that to be a very fascinating topic. There is definitely a balancing act there between how many people you hire externally and the people you promote internally. You have to balance that equation very carefully. Then on Tuesday, I did episode 383, which was called Mar-a-Lago Accord, question mark. This episode examined an article from the Wall Street Journal titled "Trump is Right About Trade Imbalances. Does he know how to fix them?" So the premise of the article is that economist John Maynard Keynes once proposed a plan back in 1941 that would balance trade imbalances between countries, but was not utilized. So Trump is looking at adopting a similar plan, which has become known as the Mar-a-Lago Accord. But part of this new accord would be to weaken the U.S. dollar and reindustrialize America. The question is, at the end of the day, can it work? So I think, again, I thought the article was great because it talks about Keynes, and it gives you a little bit more historical perspective, so it were, on kind of trade imbalances, how that can affect different countries, why that was a major factor in World War II. It talked about, a little bit about Bretton Woods and what came out of that. So again, I thought a very interesting article in terms of, looking at Keynes and talking about a little bit more of economic history, if you will. Then on Wednesday, I did episode 384, which was "How Can Your Bank Get Started with Fed Now?" So this episode examined an article from Independent Banker magazine titled "5 Ways Community Banks Can Take Advantage of Fed Now." So the authors proposed 5 steps that community banks can use to adopt Fed Now, which was: number 1, lean on third-party providers. Number 2, start with a receive functionality. Number 3, develop implementation plans. Number 4, identify use cases that offer value. And number 5, talk with your peers. So FedNow continues its growth in the first quarter of 2025 with more than 1,300 participating financial institutions. So again, very, very interesting article. FedNow continues to grow across the banking industry. Again, a lot of banks out there are just kind of dabbling with it, if you will. They're just kind of dipping their toe in the water, so to speak, with FedNow. And, I think, give it another year and let's see how, things look and how FedNow continues to progress. And then on Thursday, so Thursday and Friday were kind of like back-to-back episodes in a way, because they crossed over in terms of the Treasury report that came out. So on Thursday, I did episode 385, which was review of Treasury report on stablecoins. And I did that as a part of the ongoing crypto series. It was part 20 of the crypto series. So in that episode, we reviewed a presentation that was made by the Treasury Borrowing Advisory Committee, the TBAC, titled "Digital Money." So the Treasury believes that the U.S. dollar-pegged stablecoins are on track to reach an aggregate market capitalization of approximately $2 trillion by 2028. So very, very interesting It was a very interesting presentation. Kind of could put together like a PowerPoint, but the slides were. The only thing I didn't like about it were the slides were ridiculously busy, but some really good information in there, particularly on how the growth of stablecoin could affect deposits at banks. And bankers really, really need to pay attention to that, especially right now, as there is a lot of legislation going through around cryptocurrency, particularly around stable coins that's going through, bankers really need to pay attention to that legislation, because ultimately that legislation, how it's put together, could have major ramifications on bank deposits. And as I've said many times, bank deposits are the lifeblood of every bank. Banks need deposits in order to lend you money. So if their deposits are shrinking, it's going to be much more difficult for them to lend you money. So just something to keep in mind, to point out in general. Now, on Friday, I did episode 386, which was a review of the TBAC report to the Secretary of the Treasury. So this episode examines a recent report from the Treasury Borrowing Advisory Committee, the TBAC, to the Secretary of the Treasury. So this report covered a number of important topics that included projected funding needs of the Treasury, trade policy, long-term yields in Treasuries, Treasury's buyback program, conversion of the debt limit, and terms of issuance. So the report was released on April 29th. And so again, the crossover, if you will, between those two episodes was this TBAC report to the Secretary of the Treasury. But in the crypto episode, we only touched on the part that related specifically to stablecoins. On Friday, the report that I did covered the entirety of the report and covered all the other issues. Now, I will tell you, one of the main things that came out of that was discussion on the debt ceiling, the debt limit, if you will. The TBAC has a major concern with the debt limit and how that could really bind us in. And that is going to come to a head in August if it's not addressed sooner. Hopefully, like in the big, beautiful bill, hopefully the debt limit is addressed. Again, one of the things we talked about a little earlier was one of the things proposed was increasing the debt limit to $4 trillion. That would certainly help and fix the issue. But, does that help us with our national debt issue, so to speak? That becomes one of the big questions. Do you help the problem by continuing to increase the debt limit itself? Basically saying, hey, you're green lighting additional borrowings to add to the debt. So do you really want to do that? Do you really want to go down that road? So those were the 5 episodes that I put out this week. Based on the views and the response, I think people really seem to be liking the episodes and what I'm putting out each week, which is fantastic. Okay, but now let's switch gears for a second. So what are the economic indicators that are coming out this upcoming week? Little lighter this week, not too much economic information coming out, but on Monday, May 19th, we have U.S. leading index. On Tuesday, May 20th, we get the API weekly crude oil stock. On Wednesday, May 21st, we get the 20-year U.S. Treasury bond auction, which people will be keeping an eye on. On Thursday, May 22nd, we get continuing jobless claims. We get initial jobless claims. We get manufacturing PMI, the services PMI, and the existing home sales. So on Friday, May 23rd, we get building permits, new home sales, and the U.S. Baker Hughes oil rig count. So again, not as much economic information. Obviously, Thursday will be a big day, getting a little bit of labor market numbers with continuing jobless claims and initial jobless claims. So we'll keep an eye on that. We'll keep an eye on that. A little bit of real estate data with new home sales, building permits, existing home sales. So get some real estate data in there. So we'll continue to keep an eye on that stuff. So okay, now let's take a look at some banking news for the moment, shall we? So we get the KC Fed basically said that ag land value and credit conditions are down. So the Federal Reserve Bank of Kansas City reported that agricultural real estate values in its district declined slightly in the first quarter, while credit conditions deteriorated further. Retail sales edged up in April. Producer prices fall in April, so the producer price index decreased 0.5% in April after decreasing 0.4% in March, according to the Commerce Department. The PPI was up 2.4% from April 2024. Again, that seriously plays into the inflation conversation. So when I get back to the articles here in a minute, we're gonna take a look at the CPI was way down, but the PPI was also way down as well. which is fantastic because that means inflation just continues to come down, which is great. Industrial production capacity utilization was flat in April. Business inventory sales were up in March. Weekly mortgage rates were up just slightly. Basically, the rate for the 30-year mortgage rate was at 6.81% this week, up from 6.76% last week. So just up a little bit, but still below 7%, which is good. Okay, so Powell indicates that the Fed may tweak monetary policy framework. So the Federal Reserve is reviewing its monetary policy framework in light of the experience of the past 5 years, which we talked a little bit about earlier. House Ag Committee passes parts of Farm Bill. So the House Agricultural Committee passed a reconciliation bill that would cut the Supplemental Nutritional Assistance Program by $290 billion over 10 years and add $60 billion in farm program spending. So we'll keep an eye on that. The Durbin-Marshall bill would disproportionately hurt community banks. So new research from the University of Miami says legislation that would allow large merchants to route credit card transactions on the network that is least costly to them would have a disproportionate impact on small financial institutions. So the research found that the Credit Card Competition Act, introduced in previous Congresses by Senator Richard Durbin and Roger Marshall, would constrain the ability of community banks to extend credit, disproportionately affecting low-income households. Ultimately, this would tilt market power in favor of larger banks. So that legislation is very interesting. And what Dick Durbin and Roger Marshall, what they were trying to do on that is, I'll put it like this. So you have Visa and MasterCard have this stranglehold on the credit card market, so to speak, right? And they wanted to create kind of a third rail to give consumers another option. Theoretically, which would help to, give consumers more options and hopefully bring down the fees that they're paying on credit card transactions, right? In theory, sounds like a great thing. The problem is, who is going to be this other, third party, provider? Very interesting. So we have the Capital One and Discover Card merger. So now we potentially have a legitimate third player that could come in here and rival against Visa and MasterCard. So that, that kind of thickens the plot here on that a little bit. So again, but I think that other parts of the legislation are very misguided and not well thought out. But like I said, we will have to keep an eye on it and see what happens. Independent banker highlights how fraudsters take advantage of natural disasters. So latest Independent Banker magazine explains how fraudsters try to capitalize on people's vulnerability and generosity following a natural disaster. So the article outlines how scammers target disaster victims who may be susceptible to offers for help and how community bankers can help customers avoid compounding a natural disaster with a financial one. The CFPB withdraws proposed rules on Regulation V. So the Consumer Financial Protection Bureau withdrew its proposed rule on data broker practices, Regulation V, calling it unnecessary or appropriate at this time. So proposed on December 13th, 2024, the rule would amend Regulation V to implement certain Fair Credit Reporting Act definitions for consumer reports and the Consumer Reporting Agency, along with certain other FCRA provisions. The rule was designed to ensure protections are applied to sensitive consumer information, including information sold by data brokers. So yes, so that's being taken off for the moment. Community bankers testified before Congress on de novo formation. So ICBA community bankers testified before a House subcommittee on financial institutions hearing on de novo bank formation, basically saying that, hey, we need to fix some of basically the process of forming a de novo bank, which is a startup bank. And hopefully that will bring some positive results, in the future there, but we'll see. Small businesses' optimism declines in April. Consumer prices increase in April. The FHA deactivates 600 mortgagee letters. The FDIC ombudsman lists top concerns of 2024. I will probably be covering that report in an episode in the next week or two. Keep an eye out for that. FDIC 2024 economic growth exceeds expectations. That is according to their 2025 risk review. I will be covering that in upcoming episode. House Ag Committee begins Farm Bill markup. FDIC board meeting next week on deposit insurance fund. Bank financial officers report tighter standards for commercial loans. So respondents to the Federal Reserve's latest survey on senior financial officers share their opinions on the standards and terms on and demand for bank loans to businesses and households over the past 3 months. So I will be covering that in another episode, as that is a great survey that the Fed puts out. Congress should repeal the ILC loophole. Yes, they should. We've been talking about that one for years. I just did an episode on ILC. The ICBA, they put out a white paper detailing the evolution of the ILC charter in a very comprehensive way. So I will probably be doing an episode to cover that, again, just to give a little bit more light to this topic and to give people a little bit more information on that. So ICBA legislative priorities included in the House tax proposal. So yeah, they want to see the Acres Act, which would exempt from taxation interest on loans secured by farmland and residential mortgages in towns under 2,500 population, increasing the Section 199A deduction from 20% to 23% and making it permanent, lower individual rates, a higher estate tax exemption, and a higher alternative minimum tax exemption. So yes, all good things hopefully to come. ICBA advocated resolution scrapping CFPB overdraft rule is signed into law. So President Donald Trump signed into law an ICBA advocated resolution to overturn the CFPB's final rule on overdraft services, finalizing a key policy success for community bankers. Yes, indeed. CFPB withdrawing more than a decade of guidance materials. So the CFPB announced the withdrawal of certain guidance, interpretive rules, policy statements, and advisory opinions issued since 2011. So a CFPB notice scheduled to publish today on the Federal Register lists dozens of affected guidance materials, including its April 2023 policy statement on abusive acts and practices, advisory opinions under Truth in Lending, Regulation Z, and circulars on overdraft opt-in practices and remittance transfers. So yeah, that's, again, pretty big deal. And then finally, Treasury appoints McKiernan. So Treasury Secretary Scott Bessent announced President Donald Trump's intent to nominate Jonathan Kiernan to serve as the Undersecretary of Domestic Finance as the Treasury Department. Now, why is that interesting? I'll tell you. So McKiernan has been an advisor at Treasury while awaiting Senate confirmation to lead the Consumer Financial Protection Bureau. McKiernan previously served on the FDIC Board of Directors and held senior roles at the Federal Housing Finance Agency, the Senate, and the Treasury Department. So, McKiernan was basically already tapped to be the head of the CFPB, awaiting Senate confirmation. But now he's basically being tapped to be nominated to serve as the Undersecretary of Domestic Finance at the Treasury Department. Why would that be? Well, they're basically in the process right now of gutting the CFPB. They have said they're not going to completely shut it down. But I would say if the guy that you tap to lead the CFPB is already getting tapped to do another job at the Treasury, it looks like sooner or later the CFPB is going to be toast. And I would say that is probably exactly what is going to happen there. So undoubtedly, that is the path that we are heading down. And that's why, we should be taking a close look at McKiernan getting posted in there. So, all right. So now we have our banking news of the night. So let's get back to some of these articles here. I still have a bunch of stuff to cover with you guys here before we get out of here tonight. So on Monday, and I thought this was enormous. Trump announces order to reduce prescription drug prices. So the order would see a drop in prescription drug prices of between 30% and 80%, Donald Trump said. Now, this is huge. We basically, I mean, I can't even, and I hope it says something in here about how much we are getting charged. Basically, 75% of the pharmaceutical companies' profits come from the United States. They only get 25% of their profit. I mean, they are gouging us. They have been gouging us for decades. And hopefully this will begin to bring that prescription drug prices down. Like, you might have you guys might have a younger brother or sister that are out there paying $600 for an insulin, shot. There might be retirees listening right now. You guys might be out there paying, I don't know, $500, $600, $700 a month for your medicine. It's a huge cost for retirees. It's a huge cost for young people that have disabilities, that have problems. Hopefully this will be the first step in hopefully bringing down a lot of these prices. This is going to be a boon. This is going to be a boon for a lot of things, because what happens when these costs get brought down on consumers economically? What does that mean? That means there is now more cash in your pocket to do what? Go buy other things, go spend money on other things. So again, I think that this could lead to really good stuff, but we'll see. But again, keep an eye on it and we'll see what happens. So, okay, let's talk a little bit inflation news. So annual inflation rate hit 2.3% in April, less than expected and the lowest since 2021. So the CPI index rose a seasonally adjusted 0.2% for the month, putting the 12-month inflation rate at 2.3%, its lowest since February of 2021. The core CPI also increased 0.2% for the month, while the year-over-year level was 2.8%. Egg prices tumbled, falling 12.7%, though they were still up 49.3% from a year ago. While the April CPI figures were relatively tame, the Trump tariffs remain a wild card in the inflation picture, depending on where negotiations go between now and the summer. Got to throw that tariff card in there, right? Inflation's dropping like a rock, but they still got to put that in there. So here we go here. We can see here, basically starting in January, 3%. So over the last 4 months, inflation has come down from 3% down to 2.3%. It was up here. Core inflation was at 3.3%, now down to 2.8%. So it is coming down, and it is coming down very quickly. Here we see, U.S. Consumer Price Index month-to-month percentage change. Right here, just up a meager 0.2%. So we are definitely heading back in the right direction. Let's see here. So I wanted to point this out. Now I want to jump over here. So this is another article from Zero Hedge. So despite mainstream panic, U.S. consumer price inflation tumbles to the lowest in over 4 years. So while today's CPI will be far less relevant now than the entire macro picture has been reset after this weekend's trade war truce, which cut tariffs between U.S. and China by 115% for 90 days. So let's get to thus making any pre-cost CPI number comparisons meaningless apples to oranges. The machines will certainly be reacting to what Bloomberg prints in the flashing red headline. As we detailed here, higher than expected inflation data is likely to accelerate the increase in yields spurred by the easing in trade tensions with China. As Bloomberg's Alice Andreas notes, survey data ahead of Tuesday's April CPI report sends a clear message that firms passed rising tariff-linked costs on to consumers. So they're saying here we're getting higher prices. ISM manufacturing prices expanded. ISM services ticked up. S&P Global U.S. manufacturing firms increased their output prices. S&P Global U.S. services price advanced. Richmond Fed manufacturing showed prices received rose. New York Fed manufacturing prices received edged up. Philadelphia Fed manufacturing reported prices received gains. Kansas City Fed manufacturing prices. Kansas City Fed non-manufacturing showed selling prices rose. Dallas Fed manufacturing outlook. Lower prices. New York Fed services report prices received declines. Philadelphia Fed non-manufacturing data reflected a plunge in prices. Richmond services prices received nudge down. Optically, inflation indicators, hard, not soft survey, have notably deflated in the last month, as you can see here in this chart right here. So what did we get? Did the soft survey data once again completely decouple from the reality of hard actual data? Shocker. Despite the panic from the establishment, headline CPI disappointed, rising 0.2% month over month, pulling the headline down to plus 2.3% year over year, below the 2.4% expected, the lowest since February of 2021. So, yep, we see here from this chart, this is where we were at. Here we were at back in 2021. That's quite a difference from the Democrat-sponsored surge in University of Michigan inflation expectation, something it appears Democrats were unable to see or fear in 2021-2022 when President Biden was printing trillions in stymies to save his base from actually working for a living. That's a little harsh, but okay. Under the hood, commodity prices just inched back into inflation, plus 0.1% year over year, while services inflation continues to slide. Headline CPI, 0.2% month over. So here are the details. The index for shelter rose 0.3% in April, accounting for more than half of all items' monthly increase. The energy index also increased over the month, rising 0.7%, as increases in the natural gas index and the electricity index more than offset a decline in the gasoline index. The index for food, in contrast, fell 0.1% in April, as the food at home index decreased 0.4%, and the food away from home index rose 0.4%. Over the month, but core services rose month over month. So you see a little uptick here in core services that we look to the very right. CPI year over year, but we could see this definitely continues to come down. Egg prices, so much in focus during Trump's few weeks after Biden's, we're not going to say that word. This is a clean show. Plunged 12.7% month over month, the biggest month over month drop since March of 1984. So core CPI also rose 0.2% month over month, below the 0.3% expectation, leaving it up 2.8% year over year as expected, but the lowest since April of 2021. So again, we're heading in the right direction. And I would just point out that the core CPI and the PPI numbers, as I mentioned a few minutes ago, they're both coming down. So again, this week, very favorable inflation data once again. And again, the more inflation comes down, the more pressure it's going to put on Jeremy Powell to cut rates, because he's not going to be able to lean on that argument. And furthermore, the argument of like, oh my gosh, the tariffs are going to cause all this inflation. That argument as well is going to continue to go out the window. Now here's really interesting. So U.S. consumer sentiment drops as Americans expect inflation revival. So the latest University of Michigan Consumer Sentiment Index was conducted mostly before the U.S. China tariff pause. Now, I am really starting to get very skeptical of this consumer sentiment, all this, like, oh, we're all freaking out about inflation, whatever. I don't see people really freaking out all that much about inflation. I don't know about you guys, but I'm not going to the store and seeing prices, and I'm not freaking out the way that I was a couple of years ago when I was at the store, buying groceries and stuff like that. So, I'm really starting to call a question this, oh, the consumer sentiment is dropping because everybody's terrified of inflation because of the tariffs and this and that. There's just something about this that just doesn't sit right with me. I don't see this like panicked reaction out of consumers. So I'm definitely calling this one into question. As if you've watched, my show for the last year or so, you would know that I have, called into question the jobs report. I've called into question the GDP numbers. I've called into, a couple of years ago, I thought the inflation numbers were much higher than what we were actually being showed. I think that the unemployment numbers are much higher than is actually being reported. I have thought that these, a lot of the economic indicators have been massaged for a long time. And now I'm putting my focus here on these consumer sentiment surveys. And are you ready for it? I'm about to prove my point right now. Are you ready? This was a bomb that dropped this week, and nobody really wanted to talk about it. Obviously it got a little overshadowed with the tariff news, with the inflation numbers that came in, but this was a bomb nonetheless, and it proves my point completely. What's this? Labor Department admits hundreds of thousands of Biden jobs were fake. Wow, you're kidding me. The Biden administration claimed to have added almost 400,000 jobs from July through September of last year, but new data released this week suggests that none of those jobs ever existed. Let me read that again. New data released this week suggests that none of those jobs ever existed. Now, if you remember last year, the Bureau of Labor Statistics put out a revision that basically showed that 800,000 jobs that they claimed to have created, they were never existed. So now this is another 400,000 on top of the 800,000 revision that we already got. So that's 1.2 million jobs that they claim to have created or were created that never existed. So again, that proves my point. 100% proven right now, this week, that those job numbers were garbage. They were absolute garbage. So let's go on here for a minute here. So despite constant gaslighting by the mainstream media, Americans knew the economy was in poor shape, and these latest numbers prove it. So month after month, the government bean counters under former President Biden published overly optimistic estimates for everything from job growth to the size of the economy, only to have those numbers routinely and quietly revised down later. Every month, the BLS, the Bureau of Labor Statistics, produces estimates for the number of non-farm payrolls in the country, as well as revisions for the last 2 months' estimates. Under Biden, these revisions were abnormal in magnitude and direction, being revised down with unusual frequency. While these monthly job reports are compiled from a survey of over 600,000 businesses, of which fewer than 200,000 are surveyed each month, but the BLS also publishes much more comprehensive quarterly data called Business Employment Dynamics, BED, that come from a census of over 12 million businesses. That's over 17 times the sample size of the monthly jobs reports survey. This more accurate database was just released by the BLS for the third quarter of last year, which ran from the start of July through the end of September. In stark contrast to the monthly job reports showing an increase of 399,000 jobs during the third quarter, these new numbers show a decline of 1,000 private sector jobs. To be clear, the monthly jobs reports and the BED data do not measure exactly the same thing, and the BLS also publishes another data set called the Quarterly Consensus of Employment and Wages. Each of these reports excludes certain categories of jobs or industries like railroads, government, self-employment, agriculture, etc. That means there can be relatively small deviations between these labor market estimates in the short run, but they trend very well together over time. In fact, the more comprehensive quarterly data are used to reevaluate the monthly job reports once a year in a process called the annual benchmark. This benchmark adjusts 12 months of job data to make them as accurate as possible and always covers a period from March to 1 year to March in the following year. In early 2025, the BLS published the annual benchmark figures for the period from March 2023 through March of 2024. The result, a staggering drop of 598,000 non-farm payrolls. In other words, the monthly reports had overestimated the number of jobs during those 12 months and were revised down by nearly 600,000. That's on top of the individual monthly reports already being revised down throughout the year-long period in question. So after the downward revisions to the Biden-era jobs data are set to continue, So from March through June of last year, the economy supposedly added 398,000 non-farm payrolls, according to the monthly job reports. Yet the Fed data shows a net loss of 163,000 private sector jobs for that period. So instead of adding almost 800,000 jobs during the middle of last year, the economy likely shed more than 160,000 of them. And again, this is where I went back to at that period last year. I just kept saying, forget all the fancy math, forget all the calculations, forget all these surveys. Just use the good old fashioned eyeball test. When I would open, I look at the Wall Street Journal every day. I look at the Financial Times. I look at Bloomberg and Reuters and all these other things. When I'm looking at this, and every single week I'm seeing this company's cutting 10,000 jobs, this company's cutting 5,000 jobs, this company's cutting 2,000 jobs. Every article I see is of a company cutting jobs. How is it then that the job report magically shows up and says, "Oh, there were 150,000, there were 200,000, 250,000 jobs created this month"? How's that possible? When you do not see one article of some company adding a significant number of jobs, like say like you didn't see an article where like, oh, Meta's going to go hire 10,000 people this week, Apple's going to go hire 8,000 people. No. You saw articles that said that Apple was cutting 10,000 people and that Meta was going to cut 5,000 people and so on and so forth. So you could, just using the eyeball test, you could see that something was very wrong with these numbers right out of the gate. And that's why I say, I question this stuff. I question these numbers that are coming out. And again, the more I will be proven right. I will be vindicated in the coming months as we find out a lot of these numbers were garbage. We're going to find out that the GDP numbers from the last year or so were garbage. It's going to happen. It's going to come out. So again, just major bombshell. So we found out that hundreds of thousands of jobs just did not exist. Didn't exist. It's amazing. Okay, so this was a very interesting article. So the U.S. Treasury shocked with the second biggest budget surplus in history. So 2 weeks ago, as part of its quarterly refunding announcement, the Treasury surprised the market when it unveiled a funding need for the current quarter that was $53 billion lower than it had initially forecast in February, and which we said indicates that DOGE is indeed working and the U.S. funding needs are actually declining. Which is amazing. So needless to say, for a market that was habituated to Joe Biden's debt-funded drunken sailor spending ways, the news that the U.S. would need less, not more, spending than previously expected came as a shock, and yields slumped as less debt than expected would be required to fund the world's most indebted government, which was, again, very interesting. But again, a positive move in the right direction. So, okay, here's something that I have talked about a little bit. Lenders face tough choices as a $957 billion in commercial mortgages come due this year. So again, I've talked about this is known as the maturity wall in banking. So I've talked about this before. So commercial real estate loans worth $957 billion are set to mature in 2025. CMBS loan delinquencies hit 8.17% in April of 2025. Lenders are still willing to work with borrowers to avoid forced sales. So the wall of commercial real estate loans maturing this year could create a momentum of reckoning for borrowers holding on to troubled loans. Yes, I would definitely say this. Yeah, this is definitely an issue, and we'll have to see how banks are able to work or not work through this. Now, the maturity wall is going to increase. This is going to increase for the next 3 years. So it's basically 2025, 2026, and 2027. That debt wall is going to continue. It's going to peak. It won't peak until 27. So every year, banks have got a lot of debt. And basically this all came about because once the Fed started hiking rates in 2022, banks basically started doing what was called extend and pretend. So they were basically extending loans, pretending everything was cool, hoping that rates would come back down and that basically they would be able to refinance them in much more favorable terms. So, but what, have we found out? Basically, rates haven't come back down. I mean, the Fed cut rates by 100 basis points, but then stopped. So now, all that extend and pretend has created this, this maturity wall, if you will. And, this is going to be a lot that banks are going to have to deal with in the coming years. So I undoubtedly will be talking more and more about this in the weeks and months ahead. Okay. Now, just some general news here. Verizon ends DEI programs amid FCC scrutiny ahead of $20 billion Frontier bid. So critics say DEI fostered division and discrimination, while advocates say rollbacks could erase progress on corporate diversity. So, I did an episode talking about ESG and DEI a couple weeks ago. I think a lot of people liked the episode and had positive comments on it. I tried not to be too hard. I know it's a very sensitive topic. I really try not to delve too much into stuff like this, but I like to point it out because it definitely seems like this trend of going full blown into DEI is absolutely reversing itself. And seems like every week you see more and more companies now pulling back from this, which again, my take, I think is a great thing. Some people disagree. That's fine. That's okay. But that's where it seems like we're heading. So now let's look at a couple of interesting articles here. So why Coinbase stock plunged on Thursday. So Coinbase had a big problem. So Coinbase shares fell Thursday after the crypto trading platform said it was the victim of a cyber attack. So international contractors were likely paid to access certain customer and company data, the company said. The New York Times also reported Thursday that the SEC is investigating Coinbase's use of its verified users metric in filings until it stopped using it in 2023. So again, very interesting. So they had this huge Coinbase estimates data breach costs at $180 million to $400 million. It's a big loss. The online cryptocurrency exchange said in an SEC filing that it received an email communication from an unknown threat actor claiming to have obtained information about certain Coinbase customer accounts, as well as internal Coinbase documentation on May 11th. The company added that the threat actor likely got the information by paying non-US based contractors and other employees to collect information from internal Coinbase systems to which they had access. So again, not really great news for Coinbase. And then another article here on this. Coinbase says hackers bribed staff to steal customer data and are demanding $20 million ransom. So Coinbase on Thursday reported that cybercriminals bribed overseas support agents to steal customer data to use in social engineering attacks. The incident may cost Coinbase up to $400 million to fix, the company estimated. The crypto exchange operator received an email on May 11th from someone claiming they obtained information about certain Coinbase customer accounts, as well as other internal Coinbase documentation, including materials related to customer service and account management systems. Coinbase reported in a Security and Exchange Commission filing. The email demanded money in exchange for not publicly disclosing the information, but Coinbase says it has not paid the demand and is cooperating with law enforcement on the investigation of the incident. So very, very interesting. Fintech firm Chime plans an initial public offering. Now, Chime, a lot of people may not know, is a fintech out there that has really been making strides. It's a very popular app and has really grown by leaps and bounds. So fintech company Chime has filed an initial public offering prospectus. Chime has applied to list shares on the NASDAQ under the symbol Chime, CHYM. The firm revealed it spent $33.2 million for a jersey sponsorship with the NBA's Dallas Mavericks. So fintech firm Chime has filed for an IPO, and the prospectus revealed information about its spending on a National Basketball League NBA team sponsorship. So Chime reported 2024 revenue of $1.67 billion. Its loss from operations was $62.2 million, and the per share loss came at 0.39 cents. The company noted that it had 8.6 million active members who make 54 monthly transactions on average. Its average revenue per active member was $251. So Chime really muscling in on banks' territory with the number of basically checking accounts that it opens. So now they're going to do a public offering. I would not doubt it's going to be a very successful public offering. They're going to raise a lot of money, and they're going to continue to push into banking territory. I would not be surprised one bit if Chime at some point or another basically tries to get their hands on a bank charter, maybe once again through the ILC loophole, but we shall see. Affirm stock gains as buy now, pay later company announces Costco deal. So shares of Affirm rose Wednesday after the company announced a deal to make its buy now, pay later services available at Costco.com. So Affirm shares recently up nearly 5%, where at prices last seen in March after bouncing off April lows, though still down for the year. The company said its deal with Costco Wholesale was a multi-year pact that would let shoppers make digital purchases over time after a quick, real-time eligibility check. So again, I thought this was interesting because I have been following the whole buy now, pay later and how that has really grown and expanded over the last few years. And again, Affirm, one of the major players in the buy now, pay later market. And so again, cutting deals with Costco, expanding the services, expanding to more consumers. So again, just a very interesting thing to look at. Apple, this was very interesting. So Fortnite and Apple. So Fortnite is owned by Epic Games. They have had a real back and forth going on for a long time, and Apple blocked Fortnite from the App Store. Resubmission after court ruling, Epic Games says. So Fortnite is unavailable on iOS globally. Epic Games said Apple blocked a bid to reinstate the popular game on the App Store in the US. A judge ruled the iPhone maker was not allowed to charge a commission on purchases that consumers make outside of an iOS app. So they have basically been feuding over fees that get charged and how much Apple's allowed to charge, how much they're allowed to keep. So I found this story to be very fascinating. I'm not a video game guy. I've never in my life played Fortnite. But I find this, the guy who created Epic Games, the creator of Fortnite, I find he's a very interesting dude. Their offices are actually down in North Carolina. Read a couple of different articles about him. The guy's made himself billions of dollars. Fortnite, obviously one of the most successful video games there's ever been. And the reason for the argument is because basically they're both making a stupid amount of money off of Fortnite. Epic Games is making a ton of money. Apple's making a ton of money, but Epic Games basically feels like they're being ripped off by Apple. And I think they have had a very legitimate argument that they brought to court. So, but now Apple is basically ratcheting up this battle here by basically kicking Fortnite off the iOS globally. And obviously this fight will continue. Now, I think Fortnite has so many millions of very, very loyal followers, players, gamers, whatever, that I think it's going to be very difficult for Apple to, keep them kicked off for a long period of time. I'll put it that way. So, all right, what else we got? Robinhood woos Canadian crypto users with nearly 180 million WonderFi purchase. So Robinhood said on Tuesday it will buy Canadian crypto firm WonderFi for Canadian 250 million, so 178 million US dollars, as the popular commission-free brokerage looks to expand its international footprint. The all-cash deal values WonderFi at 36 Canadian cents per share, a 41% premium to its previous close. The crypto industry, which is staging a comeback under U.S. President Donald Trump, has seen a flurry of tie-ups in 2025, including Coinbase's $2.9 billion purchase of Deribit and Ripple's $1.25 billion acquisition of prime brokerage firm Hidden Road. Robinhood had struck a $200 million deal for crypto exchange Bitstamp last year. The company has been pursuing user growth through acquisitions and making a deeper push into crypto as it evolves beyond its roots as a stock trading app to become a more central part of its customers' financial planning. WonderFi's brand includes crypto exchanges BitBuy and CoinSquare. It processed over Canadian $3.57 billion in crypto trading volumes in fiscal year 2024, 28% higher than the previous year. The company's focus on both beginner and advanced crypto users makes it an ideal partner, said Jonathan Kerbrat, Senior Vice President and General Manager of Robinhood Crypto. So again, very interesting. Robinhood pushing further and further into crypto with this WonderFi purchase. I'm not a fan of Robinhood. I hope that's well documented at this point. I think Robinhood has done a lot of shady things to their customers over the years. I'm just not a fan, and but we'll have to see how this continues to go for them. A couple of mergers, real quick. I'm going to wrap up here in just a couple minutes, but just a couple of quick merger announcements. So, Dick's Sporting Goods to acquire Foot Locker for $2.4 billion in effort to corner the Nike market. So that's kind of interesting. So Nick's Sporting Goods plans to acquire Foot Locker for $2.4 billion. Foot Locker has been undertaking an ambitious turnaround, but its weak stock price has made it a takeover target. The combined company will have a major competitive edge in the Nike sneaker market and will provide Dick's access to international markets, plus a younger and urban consumer. So very interesting. Cable companies, Charter and Cox, agreed to merge. So Charter Communications and Cox Communications, two of the largest cable companies in the U.S., have entered into agreement to merge. The deal values Cox at $34.5 billion on an enterprise basis, in line with Charter's recent enterprise value, according to a news release. Charter's Spectrum, the brand on its cable, broadband, mobile, and other services, will become the consumer-facing brand across all customers. So very interesting. Two of the largest cable companies merging together out here, and we'll have to see what that does to the market. All right, I'm not sure what is up with that, but you know what? I am going to finish with that. So let's do our last couple things to end here, as we usually do. So I always have kind of a story of the week that I do, which can be based on a lot of different things. It could be an event. Usually a lot of it I try to base on economic history. So tonight's story of the week is the Gold Reserve Act. So January 30th of 1934, the Gold Reserve Act was signed into law by President Franklin Roosevelt. The act restored stability to U.S. currency after his monetary programs of the previous year allowed the economy to reflate. The Gold Standard Act of 1900 established that dollars were convertible to gold at a price of $20.76 an ounce. This peg restricted the money supply and meant that when the Great Depression hit, the economy was sent into a damaging deflationary spiral that the government had no policy tools to halt. So in 1933, a series of executive orders and congressional resolutions removed the dollar's peg to gold and raised the dollar price of gold, expanding the monetary supply and stopping deflation. The Gold Reserve Act tied the dollar back to gold at the higher price of $35 an ounce and mandated that all gold held by private individuals and institutions be converted into dollars at that price. The law also established the Exchange Stability Fund that the Treasury could use to purchase securities, gold, and other assets to help regulate the money supply, much as the Federal Reserve does today. So, very interesting to understand. This act also essentially outlawed the individual ownership of gold, something that was not reversed until 40 years later in 1974. So I think this is a very big thing. The government basically outlawed the buying of gold by individuals. It was a crazy step taken by the Roosevelt administration back in the 1930s. Now, why did the government reverse that? Well, they reversed it because in 1971, President Richard Nixon took us off the gold standard. So after we were effectively taken off the gold standard, basically everybody said, well, wait a minute, why, if we're not on the gold standard and it doesn't matter anymore, why can't we go out and buy gold again? So a couple years later in 1974, that was reversed and people were once again allowed to buy gold. But it's crazy to think for basically a 40-year period of time, people in this country were not allowed to own or buy gold. I mean, it's crazy to think, but that's what happened. So, okay, now let's do our quote of the week. So, have you ever met a successful person who wasn't restless, who was satisfied with where he or she was in life? They want new challenges. They want to get up and go. And that's one of the reasons why they're successful. And that was by Alex Trebek, God rest his soul. May rest in peace. May rest in peace. Jeopardy was such a wonderful show with Alex, but I think that was a great quote from him, just saying that, hey, these are the normal, successful people. They're always on the go. They always want to make things happen. They always want to get out there and do great things. They always have positive attitudes. And that is what makes them successful. So with that, everybody, I'll wrap up by saying, if you like this live stream tonight, please make sure to subscribe to the channel, and please make sure to like it. Please make sure to share the content. That really, really helps the channel out. Please check out some of the other content on the channel. If you've never watched any of the episodes out there, go out and check them out. Again, I put them out every Monday through Friday. Most of the episodes are between 10 and 20 minutes in length, so easily digestible in short bites. And like I said, I do the live stream here every Saturday night at 8 o'clock. Remember, we are on YouTube, Rumble, and all major podcast platforms, so you can find us out there all over the place. Make sure to go and check out thebankernextdoor.com, as I have, constantly making changes and putting up good things on there. And with that, I bid everybody a fond farewell. I hope everybody enjoys the rest of the weekend. Have a great week out there, and I will be back same time, same bat channel next week, 8 o'clock Saturday night. We'll be back in the strategy room. Again, have a great weekend out there, and I will see everybody again real soon. See you later, and thanks a lot for listening.